Welcome to Informed Investor. Today we'll discuss two important stories. Firstly, Reliance Power has been making waves with its shares surging 5% and hitting upper circuit after the SECI withdrew its order barring the company from renewable energy tenders. Secondly, we'll deep dive into Swiggy's Q2 results, following which Swiggy has leaped 9% to hit all-time highs. Okay, now without any further ado, let's begin. In the fast-paced and ever-evolving business landscape, Anil Ambani's Reliance Power has been through a roller coaster ride. From soaring ambitions to facing the heat of debt regulatory challenges, the company has seen it all. But as the tides turn and market shifts, Reliance Power is once again in the spotlight. This time, its shares have hit the upper circuit, soaring 5% today after the SECI or Solar Energy Corporation of India withdrew its debarment notice of 3 years against Reliance Power. This means it enables Reliance Power to participate in future tenders for clean energy projects, offering a glimmer of hope. In context, the SECI is the key authority in India's renewable energy space and serves as the nodal agency for implementing India's green energy initiatives. But before we jump into all of this, let's briefly go through the history of Reliance Power. Established back in 2007, Reliance Power is part of the illustrious Reliance Group, one of India's biggest business houses. It is primarily engaged in the development, construction and operation of power projects. But soon after, with the younger Ambani, Anil Ambani at the helm, the company faced several challenges. One of the notable setbacks was the high debt levels and operational inefficiencies. If you see the chart, the debt levels had reached a peak of 33,790 crores in March 2016. However, the company's fortune began to shift as it focused on restructuring and reducing its debt burden. In the most recent second quarter of this year, it has reduced its debt to 14,903 crores. Now moving on to some recent development. As of December 2024, Reliance Power is witnessing a revival. The recent withdrawal of SECI's debarment notice is particularly noteworthy. To provide a bit of context, on November 6, 2024, SECI had imposed a notice and barred Reliance Power from participating in its clean energy project tenders for 3 years and was weighing criminal proceedings against the company after a bank guarantee turned out to be a fake endorsement for a battery energy storage system project. After the withdrawal of this debarment notice, it has resonated positively with market participants and reinstated investor confidence. But why is this so significant? Most important is that it allows Reliance Power to re-enter competitive bidding for renewable energy projects facilitated by the SECI. Furthermore, this enhances the company's market position, signaling a turnaround in the operational capabilities and future prospects. Following this, shares of Reliance Power hit the upper circuit, surging by 5%, creating a direct reflection of this renewed optimism. Now, while the withdrawal of the debarment notice is certainly a positive step, it is important to note that Reliance Power still faces significant challenges. The company needs to address its debt burden and improve its operational efficiency. While the industry has tailwinds with India's commitment to increasing its renewable energy target significantly by 2030, companies like Reliance Power are well positioned to benefit from the government tenders and projects. However, only time will tell how Reliance Power creates a strong foothold in the growing energy market. Now moving on to the second story. Swiggy, the prominent food delivery and quick commerce platform, recently released its financial results for the second quarter of fiscal year 25, marking its first earnings report since going public. The results have generated significant market interest, reflecting in a surge in its share price, rising about 2.8%. The increase comes after the company reported strong Q2 results driven by growth in its food delivery and grocery segments. But wait, before we decode the results, let's do a quick business overview. Swiggy is one of India's largest on-demand delivery platforms, starting with food delivery and now expanding into multiple services to become a one-stop solution for daily needs. If you see the image, Swiggy focuses primarily on its core service, food delivery, complemented by its quick commerce platform Instamart, which facilitates the delivery of everyday essentials. Additionally, the company offers Dine Out, a service for restaurant reservations and offline dining experiences. Swiggy Genie provides pickup and drop services catering to various logistic needs. Lastly, Link Logistics is a platform dedicated to offering transportation solutions. Now, if you look at the revenue breakup, Swiggy's revenue is primarily driven by the food delivery, which accounts for 47% of its total revenue, followed by its supply chain and distribution services at 39.4%. Quick services arm Instamart generates about 11.6% of total revenue. And recently, Swiggy also launched Bolt, which is a 10-minute delivery service. Interestingly, within its 8 weeks of launch, it already accounts for 5% overall food deliveries. Okay, now let's deep dive into Swiggy's Q2 results. Now, looking at the financials, Swiggy reported a robust revenue from operations of 3,601 crore for Q2 of fiscal year 25, representing a 30% year-on-year increase from 2,763 crores in the same quarter last year. If compared to the previous quarter, its revenue rose by 11.77%. Now, if you look at the bottom line, the company's consolidated net loss narrowed slightly to 626 crore, down from 657 crore year-on-year, but up from 611 crore in the previous quarter. This indicates that while Swiggy is still operating at a loss, it is managing to reduce its losses on an annual basis. The adjusted earnings before interest, tax, depreciation and amortization loss stood at 341 crore, which is significant improvement of 30% year-on-year. This suggests that Swiggy is making strides towards operational efficiency. Now, if you look at the operational highlights, Swiggy witnessed strong growth in orders and gross order value, with total orders increasing from 192 million in the second quarter of fiscal year 24 to 230 million in quarter 2 of fiscal year 25. Gross order value grew by 29.9% year-on-year in quarter 2, reaching 11,306 crores. Even Swiggy's monthly transacting users increased by 19.2% year-on-year, reaching 17.1 million, displaying strong customer engagement. Now, to conclude, let's highlight some key takeaways. Over the last 5 quarters, Swiggy's overall adjusted EBITDA loss margin has been narrowing. In the food delivery segment, there has been improvement, with adjusted EBITDA margins reaching 1.6% in the second quarter of fiscal year 25. At a consolidated group level, Swiggy aims to achieve positive adjusted EBITDA by the third quarter of fiscal year 26. While this is an encouraging target, it is a long-term goal that depends on consistent operational efficiencies and cost management. One of the steps Swiggy is exploring is increasing the delivery fee for orders placed on Instamart. This could help boost revenues, but it may also test customer price sensitivity in an already competitive market. Additionally, Swiggy has piloted the Bolt program, which promises 10-minute food delivery. Within just 8 weeks of launch, Bolt accounted for 5% of total orders, which demonstrates early traction. However, scaling this program will depend on operational efficiencies and cost effectiveness. In summary, Swiggy has made some progress, particularly in improving margins in the food delivery segment, and its strategic initiatives shows potential. Having said that, this is me, Rahul Hassan, signing off. Have a great day and stay safe.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.